Welcome to Two Guys.
A girl.
and an MBA.
Reuters reporting Moody's cuts America's pristine credit rating, citing rising debt. Moody's downgraded the U.S. sovereign credit rating last Friday on their $36 trillion debt pile, which is crazy. Moody's it's the last of the three major credit agencies to downgrade it, so they were the holdout. And they first gave the United States the pristine AAA credit rating in 1919. What does this mean for the market? It means higher long-term rates that pushed above 5% because now the U.S. debt is perceived as riskier because it's not risk-free uh, anymore, as we've talked about previously on this channel. Uh, the impacts are obviously going to be global, and it shook the markets last week quite a bit. I was feeling it in my portfolio. Maybe you were in your portfolio. Comment below. What do we think about Moody's downgrade? And it's only they're AAA to AA or something like it. It's like one peg down, but that's a huge peg, right?
So maybe you know better. What does that mean, really? Like, who cares? AAA.
What it means is that the credit agencies are assessing the risk of default. So they assess not just governments but also corporations. So what's the likeliness that this company will pay back on its bonds, on its debt? So it's kind of like, how you get a credit rating from on your credit card or whatever. If you get a higher credit score, you get a lower rate. It's kind of like that. If you have a AAA credit rating, the yield on the U.S. debt is going to be lower. The interest rate's going to be like, let's say 2, 3, 4%. It's going to be less risky. More risk, more reward, less risk, less reward. By downgrading the debt, what they're really signaling to the market, it's more about the signal than anything. We don't trust the U.S. We don't have faith in the U.S. debt that they're going to pay back on this 36 trillion, right? They cited the debt pile in the downgrade, and that's what shook investor confidence. And what that means is long-term rates is going to push up higher. Higher rates mean, a lot of has a lot of implications, Yeah.
All right. So it's not good news. But
Not
I
good
don't.
news for US.
Yeah, but
It,
I think. So what does it mean? Like, I'm trying to figure out. Like, I mean,
it,
interest
oh,
rates. Yeah.
for example, the cost of mortgages should now go up. The cost of, auto loans should go up. The interest, the US is going to have to keep borrowing more because there's still running a deficit. So the future interest rates are going to be, they're going to have to pay out higher yields on that debt. So it's going to be more expensive. So the huge interest payment I think we've talked about before, it's like almost $1 trillion, almost equivalent to the interest payments on the US debt is almost equivalent to the military budget of like 800 something billion. That's going to get higher now because investors are going to demand a higher yield because now the US is not as safe of a place. It's going to cause the dollar to weaken, which you already have seen it happening this week. I've seen it, weakening the dollar because it's not as, you know, people aren't as confident that they're going to get a return. So there's a flight out of dollars. They're selling their US bonds and then they're getting out and into other currencies, other foreign debt that's safer. It's not good. It's not good for the US.
It's good
Not
for
good.
Europe, for Asia, for Middle Asia. So it's good because people just turn their plans, loans, business investments to the other continent, to Canada.
So isn't this a justification for all his policy and craziness? Because it was the downgrade was because of the $36 trillion debt and not being able to service this thing. So he could use it as an argument that, I told you this is this.
Mm.
So I mean, I remember, back in the day when you used to just worry about like gas prices and, because
Mm.
you need to go clubbing or something. Now we're talking about AAA debts and interest rates and everybody's like opinion. And it's like, oh my God. Can't we go back to the 90s, man? It's
The
just like,
crisis, there is also finance crisis in 90s into millennium
eh,
is
probably.
oh my God. So it was other issues there.
I think what the last time the U.S. had a surplus was, that's why you're citing the 90s,
Yeah, it was happy times.
was in the middle of Bill Clinton's
Yep.
presidency. There was a surplus. That's like 30 years ago or
He's
something.
just playing the sax. He's like, I mean,
Mm,
meeting some ladies.
ah,
Everything was happy. Arsenio Hall. I remember it's like everybody's just happy. There's nothing
maybe
going
because
on.
of other countries were weak, because it was after Soviet Union time, Europe also shaking,
Mm,
China was not so strong as it is right now.
yeah.
So because Kuwait and others, this countries still, I don't know if that's one. So yeah, it still was developing in Europe and Asia, and yes, just
Mm.
so no competitors that time. So that's why it's this.
Wasn't that Desert Storm too? Or wasn't it the 90s? Yeah, it was the 90s.
Yeah,
Yeah,
90.
yeah, you got it.
I was in it. I was
Yeah,
evacuated
you were.
from,
Yeah.
yeah, I was
Whoa,
in,
yay.
yeah.
Yeah, from Kuwait. That's
I
right.
was
So
here. Yeah.
the US was in a war. I mean, I guess that's the thing. When US is in a war, happy times economically, it
No,
seems.
I think Oleno hit it right on the head. It was the fall of the Soviet Union, and it
Yep.
was kind of the end of American hegemony before the rise of China,
Mm-hmm.
before the dot-com crash, before 9/11, that was like the last hurrah. And then since 9/11, kind of really probably before that, since the tech bubble, the empire has been in decline. Please consider subscribing below.
Thank you for being with us. Please leave your comments, feedback, what you think about us, and see you in the next podcast. Bye.